Welcome to this lesson on investing basics. Today, you'll learn about one of the most powerful tools for building wealth, investing. Understanding how to make your money work for you is essential for achieving long-term financial security and reaching your financial goals. Let's dive into the fundamental concept of investing and how it can help grow your wealth over time. At its core, investing is the act of allocating money into various assets with the expectation of generating returns over time. Think of it this way: instead of letting your money sit idle, you're putting it to work. When you invest, you're purchasing something today that you believe will be worth more in the future. This could be stocks, real estate, bonds, or other assets. The key idea is that your money has the potential to grow and generate additional income beyond what you initially put in. It's important to understand the difference between saving and investing. Saving is about preserving your money with minimal risk, typically in a bank account. While savings are safe and accessible, they offer very low returns that often don't keep pace with inflation. Investing, on the other hand, involves taking calculated risks with your money in exchange for the potential of higher returns. While investing carries more risk than saving, it provides the opportunity for your wealth to grow substantially over time. Both saving and investing have their place in a healthy financial plan. There are several compelling reasons to invest your money. First, investing helps you build wealth over time through compound growth and appreciation. Second, it helps you beat inflation, which slowly erodes the purchasing power of money kept in low-interest savings accounts. Third, investing is essential for achieving major financial goals like buying a home, funding education, or retiring comfortably. Finally, investments can create passive income streams through dividends, interest, or rental income, giving you financial freedom and flexibility in the future. There are many different types of investments available to choose from. Stocks represent ownership in companies and can provide growth through price appreciation and dividends. Bonds are loans to governments or corporations that pay regular interest. Real estate involves purchasing property for rental income or appreciation. Mutual funds pool money from many investors to buy a diversified portfolio of assets. Commodities include physical goods like gold, oil, or agricultural products. Exchange-traded funds, or ETFs, are similar to mutual funds but trade like stocks on exchanges. Each investment type has different characteristics, risk levels, and potential returns. One of the most fundamental principles in investing is the relationship between risk and return. Generally speaking, investments with higher risk offer the potential for higher returns, while lower-risk investments typically provide more modest returns. This is because investors demand to be compensated for taking on additional risk. Understanding this relationship helps you make informed decisions about where to put your money based on your financial goals, time horizon, and comfort level with risk. The key is finding the right balance between risk and return that aligns with your personal situation. Successful investing is built on several key principles. First, start early. The power of compound growth means that even small amounts invested early can grow substantially over decades. Time truly is your greatest asset in investing. Second, diversify your investments. Don't put all your eggs in one basket. Spreading your money across different asset types and sectors reduces risk. Third, stay consistent. Regular investing, regardless of market conditions, helps you build wealth steadily over time and takes advantage of dollar-cost averaging. These principles form the foundation of sound investment strategy. Ready to begin your investing journey? Start by setting clear financial goals. Know what you're investing for and when you'll need the money. Next, understand your risk tolerance. Be honest about how much volatility you can handle without losing sleep or making emotional decisions. Third, research your investment options thoroughly. Learn about different asset classes and investment vehicles before committing your money. Finally, start small and learn continuously. You don't need a fortune to begin investing. Start with what you can afford, learn from experience, and gradually build your knowledge and portfolio over time. Remember, investing is a lifelong journey of learning and growing your wealth.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.